doing international trade, one thing that comes to our mind is how to cover the associated risk in case of non-payment of export proceeds by the buyer. At the same time, the things of great inquisitiveness are like how to provide credit to the overseas buyer. Is credit extending to importers safe? How can an exporter provide credit to an unknown buyer? What is the remedy to provide credit to an overseas importer? There comes the role of ECGC, that stands for the Export Credit Guarantee Corporation. Now, food for thought is, what is ECGC? And how does ECGC protect exporters' companies and offer insurance to cover the risk of non-payment of export goods value? Is there any insurance to protect the exporter in non-payment of exported amounts, etc., etc.? So, let us understand ECGC. Export Credit Guarantee Corporation is a central government undertaking body to provide credit guarantee on the default of payments by the buyer. It works as an insurance firm who guarantees export payment if the buyer defaults in making payment. The Export Credit Guarantee Corporation of India Limited, ECGC in short, is a company wholly owned by the Government of India. It provides export credit insurance support to Indian exporters and is controlled by the Ministry of Commerce. Initially, the Government of India had set up Export Risks Insurance Corporation (ERIC) in July 1957. It was transformed into Export Credit and Guarantee Corporation Limited (ECGC) in 1964 and to Export Credit Guarantee of India in 1983. Talking about the capital, the organization has Rs 1,000 crores of authorized capital, in comparison to Rs 900 crores of paid-up capital. To understand the objectives behind the establishment of ERIC, we must understand the concept of risk. A business needs to explore a new market and dive into the ocean of opportunities in order to tap the maximum potential. Fearing the risk, they cannot stay in their own shell. Although, statistics say, every day one organization fails. Every day a new business is formed, every day a company changes its name. Every day a company changes directorship, every day a company changes share ownership. Every day a company changes its control and a new sets of accounts are keyed in. Hence, an organization, Export Credit Guarantee Corporation of India, was set up to protect the interest of various stakeholders who are participating in the transnational trades and seek the potential of achieving greater heights. Some of the credentials of the organization include, it is registered with IDA and has a Memorandum of Understanding with the Government of India. It is ISO 9001:2000 complied organization. At the same time, it has been ranked as IAAA by ICRA. The creditworthiness of the organization can be just as it is the world's oldest organization spread in 237 countries and has a global expertise of being member of Berne Union. Talking about the major functions of the organization, firstly, it provides a range of credit risk insurance which provides cover to exporters against loss in export of goods and services as well. Second, it offers guarantees to the banks as well as the financial institutions for enabling the exporters to obtain better facilities. Thirdly, it provides overseas investment insurance to Indian companies investing in joint ventures abroad in the form of equity or loan and advances. We can say that the Export Credit Guarantee Corporation covers by and large all the domestic and foreign risks in the form of credit insurance. The need of the Export Credit Guarantee Corporation is evident from the statistics, which clearly depicts that the number of claims due to defaults on insolvency have grown manifold in past few years. Why this number of defaults is even higher in developed countries. Thus we can say there is a dire need of such an organization who can protect the vested interest of foreign trade stakeholders. Therefore, in order to protect the interest, it facilitates insurance protection to exporters against payment risks of sellers from both domestic and foreign buyers. Guidance in export-related activities for its initiation, expansion and promotion to the greater extent. Information on different countries with its own credit ratings and creditworthiness of overseas buyers. Guarantee to obtain export finance from banks or financial institutions. Recovery of exporters' bad debt. As of now, it can be believed that the organization is a lot protect and promote the international business operations. But now you must be thinking, how can you proceed and buy an ECGC to insurance cover? Firstly, an exporter and an importer finalize an order. After finalizing the order, the buyer executes a purchase order to the seller with the terms and conditions as agreed by both. This purchase order should contain full details of buyer and buyer's bank account details. The exporter then approaches the Export Guarantee Corporation to get approval on the buyer with an amount of limit. Here, the ECGC contact with overseas networks and find out the creditworthiness of the said buyer and arrive at a figure of creditworthiness and inform the maximum limit of amount can be shipped at any point of time. This is to be remembered that, for this purpose, Export Credit Guarantee Corporation collects premium on the amount of approval and issues insurance policy accordingly. Doing international trade, one thing that comes to our mind is how to. The exporter can apply with ECGC for insurance on shipment-wise order as specific insurance policy, or at lump sum as comprehensive policy. If an exporter obtains a specific policy, the contract of insurance is only for that particular shipment. You as an exporter have to pay premium only against the said shipment. If you prefer to obtain a comprehensive policy against any buyer, you can get approval from ECGC, the amount of creditworthiness of the said buyer. You must be thinking, how does various policies of ECGC, comprehensive or specific, work for exporters? Comprehensive policy is one of the popular risk cover policy of ECGC Export Credit Guarantee Corporation. ECGC functions as a service provider to exporters in extending creditworthiness of buyers. ECGC assures amount of consignment on default of payment by buyer. ECGC collects premium against such insurance cover. One of the major insurance policies of ECGC is comprehensive policy. Let me explain in simple terms about comprehensive policy of Export Credit Guarantee Corporation. You are an exporter. You obtained an order from Avocado, an overseas buyer, to ship them goods for 6 months for $6,000. The buyer instructed you to ship goods worth $1,000 per shipment each month. Means you ship 6 times in each month for $1,000 per shipment and a total of $6,000 for 6 months. As per the agreed terms by you and your buyer, the credit period you have allowed is 60 days DAP-D.A. Means 60 days from the date of particular shipment, your buyer has to pay the amount of $1,000 to you. Again in next month the buyer has to pay $1,000. Again in next month the buyer has to pay $1,000 against the second shipment you have shipped to your buyer. This process continues till the 6th shipment effect. You approach ECGC and apply with your buyer's complete details on their bank address. Based on the available data and market research, ECGC approves a credit limit of $2,000 against the particular buyer, Avocado. This means the total outstanding liability of the existing buyer, Avocado, should not exceed the limit of $2,000 at any point of time. Please pay attention here to make clear about how comprehensive policy of ECGC work. Based on the above example, let us learn the procedures to be followed while shipping goods. As per the example, you effected first shipment on 10th of April. Once after shipment, you have sent all required shipping documents with original bill of lading or airway bill with bill of exchange for acceptance, though your bank, to the buyer's bank. Documents reach buyer's bank and buyer accepted documents. The due date of payment falls on the 10th of June. You have effected a second shipment on the 10th of May worth $1,000 as per your purchase order. The due date of this second shipment falls on the 10th of July. Please note, your total outstanding liability at present is $2,000 US. Remember, you have an approved limit of $2,000 US against this particular buyer. Your third shipment is expected to effect on the 10th of June. Once you ship third shipment, the total outstanding liability would be $3,000 US, which is not permitted by the ECGC, however. The due date to receive the export amount under first shipment is due on the 10th of June. In this case, you are not supposed to ship the third shipment. You can request the buyer to allow you to ship third shipment once after receiving the payment for the first shipment. Special schemes consist of a bundle of covers addressing the needs of banks and investors in foreign ventures. These schemes are targeted at specific audiences such as banks, investors in foreign countries and exporters taking up long-term projects abroad, covering distinct risks faced by them. ECGC offers three types of special schemes. First, transfer guarantee. Transfer guarantee scheme is provided to safeguard banks in India against losses arising out of confirmation of letter of credit (LC). It covers losses due to political risks up to 90% and losses due to commercial risks up to 75%. Second, overseas investment insurance. This scheme provides protection to Indian investments made abroad. Any investment made by way of equity capital or untied loan for the purpose of setting up or expansion of overseas projects will be eligible for cover under investment insurance. Third, exchange fluctuation risk. It covers exchange fluctuation risk of exporters of capital goods, civil engineering contractors and consultants who may have to receive foreign currency payments over a period of years for their exports, construction works or services. Moving ahead, what does ECGC do on default of payment of any overseas buyer? We have discussed the default of payment by overseas buyers and insurance coverage by ECGC. Export Credit Guarantee Corporation reimburse the export proceeds. If the overseas buyer has not paid the amount of export proceeds to the exporter, if such transaction has been insured by ECGC. Okay, now after reimbursement to the exporter, what does ECGC do? Will ECGC keep quiet? No, Export Credit Guarantee Corporation, with their network of connections, finds out the actual cause of default. If ECGC's investigation report finds that the cause of default is willful and is not satisfactory, such firms will be blacklisted. But what happens if a firm is blacklisted by ECGC? In that case, if a buyer-importer has been blacklisted by ECGC, such information is circulated among all international associates of ECGC in turn. Such buyer cannot buy import goods from any other suppliers, sellers, exporters on a credit basis. ECGC circulates this default of payment with all their international contacts and takes up the matter legally with higher legal levels. Also, this overseas buyer will be blacklisted by Export Credit Guarantee Corporation and circulated with all their associates' counterparts. Once an overseas buyer has been blacklisted, he cannot buy goods from anywhere in the country, as ECGC does not approve their creditworthiness to exporters and bankers. What is the difference between ECGC and EPCG? Both terms are not correlated, but both the terms are used in export-import business in India. Let us find out what is EPA and how EPA works. Also, let us know what ECGC is and how ECGC works. What is EPCG? EPCG means Export Promotion Capital Goods. You, exporter, are a manufacturer. You would like to import machinery in your factory from foreign country. As I have explained previously, the government supports exporters who earn foreign currency in various levels of financial assistance, exemption of import duty, etc. in this case. The machinery you are importing is used for manufacturing goods which are required to be exported where you earn foreign exchange. However, you need to pay a good amount at a time, and you will benefit from the imported machinery in coming years only. Apart from much other financial assistance for exporters, you can get exemption of 100% import duty amount while importing such machinery. While obtaining an EP license from the government, you guarantee that you will export the required amount or quantity of goods for next 5 years. The importer has to approach EP license from Licensing Authority, Director General of Foreign Trade, D.G.F.T. Application for EPA with necessary supporting documents is filed with DGFT, and based on the value of machinery the value addition is fixed up and export obligation has to be fulfilled. Accordingly, if you could not complete the export obligation in time specified by licensing authority, you can request them to get extended the export obligation period. However, if you have already finished export obligation, you can sell the goods locally also in the domestic tariff area. However, the ECGC acts as an insurance firm who covers credit risk against overseas buyers. ECGC guarantees payment on default of any overseas buyer in an export trade once after covering an insurance policy against the said buyers with ECGC. For any feedback and topic inclusion, please write in the comment section. Please like and share the video to learn more topics. Don't forget to subscribe to the channel Autodidact to stay updated. Till then, stay healthy and happy. All the best.